Hi, everyone. Thanks for joining us today for this NeoGroup webinar on risk management. More specifically, we'll be speaking about the importance of location-based risks in your overall supply risk management program. I'm Laurence Blanchette, the marketing manager here at NeoGroup. And in just a few moments, I'll be joined by NeoGroup's resident risk expert, Christine Ferrusi Ross. But before we get started, I have a few quick points to cover. As always, I want to encourage everyone to ask any questions and share your comments throughout the presentation. We'll do our best to pause and address your questions as we go along, but we also have some time set aside at the end of the presentation specifically for Q&A. Also, just a quick note that the webinar will be recorded, and I will share both the recording and a copy of the slides with you via email soon after the session. So if you're joining us for the first time, this next slide will tell you a little bit of background on NeoGroup. NeoGroup is a management consulting company that was founded in 1999 with a singular focus on helping clients better manage their entire services supply chain. We do this primarily through three offerings: advisory services, governance solutions, and supply monitoring and analytics. So let's move on to today's session. I'm going to switch it over to today's presenter, Christine Ferrusi Ross, who is a partner and senior vice president here at NeoGroup. Over to you, Christine.
Thanks, Laurence, and thanks everyone for joining us today. We're really excited to talk about location-based risk. Some of you who we've spoken to in the past and have participated in other webinars know that we spend a lot of time talking about supplier-related risk. And really, we feel strongly that you can't separate supplier risk from location risk. It's actually been my background over the years to talk about supplier-related risk and other global sourcing issues like location risk, and so I'm really excited to spend some time talking to you about this today. So for an agenda, we're going to talk about some of the major events that have affected location risk, talk about using that risk to information to lower your supplier-related risk, and then being able to take action on location risks. One of the things that we definitely see when we talk to clients is that there's the perception that supplier-related risks are things that we can be active about, but that location-related risks, if you think about weather-related issues, typhoons, floods, earthquakes, or other kinds of natural disasters, or you think about, political events that are happening, uprisings, etc. A lot of times people think they don't have any control over those things, which actually is true. But it's not about control, it's about risk mitigation. And there actually are a lot of actions that people can take because of that. So that's what we wanted to talk about today and is the focus of the last half of the presentation. So as a quick highlight, I wanted to talk about the overall risk management process because while I do want to talk to you today a lot about the action plan and sort of making this really work for your organization, I did want to highlight the overall process, right? So if you haven't started a risk management process yet, particularly in the supplier space, normally you'd start with deciding what risks matter, right? So a risk is actually the outcome of something bad that happens, not the bad thing itself. So for example, if you thought about a natural disaster like an earthquake, it's not so much the earthquake that's the risk, it's that your facilities, say, that's on the fault line can't operate, right? So the risk is that your business has an operational risk that you can't deliver what you're supposed to deliver, and the earthquake is actually just a trigger event that makes that risk happen for you. So you have to understand the risk, and then you have to assign responsibility inside your company for tracking the events that might make that risk occur, and then for taking action on those risks. So you'll notice that that's pretty early in the process, and you'd think that, gee, wouldn't I figure out afterwards who's going to take care of it? But it's actually really important to assign that responsibility early because you're going to need those people who are your domain experts to help you decide the risk indicators that you want to track. So for example, if you don't assign your finance people to help you determine financial risks, then you'd be potentially creating risk indicators for financial risk that maybe the finance team would not agree are the important ones. So you need to have the people who are responsible help you build the risk indicators, right, so that you know what you're looking for. So if the risk is that a supplier, for example, starts to become unstable, then you have to know what indicators you're looking for there. Is it that you're looking for a lowered revenue every quarter? Is it that their revenues can be okay as long as they're not losing money, right? They can say be lowering their revenue as long as they're not unprofitable, or vice versa, right? There are different ways that people can calculate those kinds of risks. So if you don't know what you're looking for, then it becomes harder to decide what to do about it. And that's actually the next step, which is creating the action plan. So once you know what risks you're looking for and what trigger events might make that happen, then you actually have to know, if this happens, we will do this. I'll actually get into some more details about that. And then you have to track all those trigger events, and I'll show you a little bit more about that. And then the big part is you actually have to do something about it, right? One of the hardest things that we hear people talk about is, in hindsight, it looked like it was really a big deal, but in the moment, we weren't sure what we should do, if anything, about it. So if you have all those actions predetermined, then when something bad actually happens, or something good, right, because risk can actually be decreased, not just increased, then you have to look at that and say, okay, there's an action that we had already determined we would take here. So we don't have to, right in the heat of the moment, worry about what we should do. We'll already have made that decision, so now we just have to implement our plan. So it's really important to understand this process, because as I start to go through and talk about some of the actions that you could take, a lot of those actions that you can take, you'd really have to know in advance whether or not those were things that you might want to do, to be a little bit more proactive about it. Of course, you can come up with actions on the fly, but it's always a little bit better to have them in advance. So a framework also helps structure the way that you think about risk management. So this is the model that we use at NeoGroup for the product that I run called Supply Wisdom. So you can see the supplier-related risks on top. We're really going to talk about the cities and the countries in this session. So there are 8 risk types that we track. So the risk of a location's macroeconomic status, its geopolitical status, its financial risks, legal risks of working in that country, business risks of working in that country, scalability risks of that country. So, for example, maybe you like what's there, but if you need to grow your capabilities in that country, maybe it just doesn't have the scalability to support that. Infrastructure risks, and then quality of life risks. So if you know what kinds of risks you want to track, and then you can put them into a framework like this to help you, again, decide what actions you should be taking. So keeping this framework in mind and the kind of risks that NEO has been tracking for many years now, right? For geographies and locations, if those are the risks, right? So again, financial risk, for example, or infrastructure risk, there are trigger events that we talked about earlier, and these are some of the kinds of trigger events, right? So a credit rating downgrade, for example, would be a risk indicator. It would be a trigger event for financial risk, or at the geography level, it would be a macroeconomic issue. Changes in a country's budget cycle that they might be going through, that would be an event that would be triggered under the macroeconomic. Same thing as stock market volatility, etc. So these are some of the kinds of events that could trigger alerts as part of tracking those different risks. So if you remember where in that circular process that I showed you, once you know what risks you're tracking, then you have to decide what events you're looking for that might be indicators of that risk. So that's what these events are in our model when we track our specific risks. So I went back and I looked. I know that we're not quite at the end of the quarter. We've got a couple of business days left, but I wanted to kind of highlight that so far we've tracked about 400 different impact events on global location risks. And what I think is really interesting about this is, if you notice, there are very few high impact events, right? An event that would be really urgent, that yes, this is something I have to do immediately, right? Which on the one hand, of course, is good, right? Because, not too many massive, let's call it like a black swan event that we weren't expecting, or like something really major like a huge coup or a political uprising somewhere recently that would cause Q1 to be risky for specific locations. But there actually were a fair number of medium impact events, which were the reddish kind of brick red color there. And the reality is there are also a lot of low impact events. And again, when you look at it in total, what's really good to understand about this is that not all events have the same impact, and also that they have different treatment options, which of course makes sense. But again, in your planning cycle, right, you might look at this and say, okay, this is really good news. So if there really weren't that many high impact events, there are very few events that actually need my attention, right? Because a lot of times people will say like, oh, I'm only really worried about high impact. So events that would have a very high likelihood to trigger the risk that I'm worried about. It's actually not really the most sophisticated way to look at it to only worry about high impact events. And I want to talk about that a little bit more. All of the high impact events that we found, though, were in geopolitical category, right? So a lot of epidemics, for example, swine flu in India, we'll talk a little bit more about that. The medium impact events tended to be spread across all of the categories. So there were some events that factored into macroeconomic risk, some that figured into the infrastructure risk, some that were geopolitical risk, and that there were some risk categories that had only low impact events. And so in fact, if you thought about quarter to quarter, some of those risks didn't change very much because there weren't many big events or events that might significantly change the scoring of that particular risk to make it either rise or fall. So talking about the action plan, and how we were just talking about the relatively few number of high impact events, I want to get back into that and talk about, as we're thinking about this, what does it really mean and how do we address the different levels of impact, and how you can actually create an action plan that helps you become more competitive. So ironically, it's actually the medium impact events that you have to worry about most. I know, and it seems, again, a little bit counterintuitive because most people tend to gravitate toward the high impact events as the things that they're really worried about. But the reality is everybody pretty much knows low impact events require further monitoring, right? You're going to look at an event and say, okay, in isolation, that doesn't really mean that much, so that's okay. But I'll keep watching, and if this small event keeps happening or it gets bigger. But for the most part, all I'm really going to do is monitor that event. So low impact events don't tend to require an immediate response. High impact events actually present a very clear course of action, right? Or if it's severe enough, sometimes you're prevented from having a proactive response and you can only reactively respond to something. So for example, earthquakes are a good example that obviously we're getting better across countries in terms of predicting those things, but still, most of the time, once that happens, you're just left to react to it. You don't actually need to do something in advance, within a few days of that, for example. Right? So high impact events, again, there's usually a clear course of action. You have to, in the case of, say, swine flu, you have to evacuate someplace, you have to go under quarantine. There are different very clear actions that would happen because of a high impact event. So it's pretty clear what needs to be done for low impact and high impact. So it's really the medium impact that are not that clear. They're neither scary nor forgettable, right? They're the kinds of events, and we all have these in our personal lives, right? You sort of see something and you start to wonder, like, should I do something about that, right? I mean, think about the news, and you talk about people who see somebody being attacked, and in the moment you're not sure, like, do those people know each other? Should I be doing something about it? And it's a lot of times not very clear in the moment what needs to be done, even though after the fact it seems like it was a lot clearer than it was. And that's what happens a lot of time with medium impact events. So for example, at the supplier level, maybe your supplier is having cash flow problems. And in the grand scheme of things, that might not seem like a high impact event, but you need to figure out what you're going to do about that. And at a location level, it's the same thing, right? So if you think about, for example, something like the rising tensions in the Ukraine with Russia that had been happening recently, right before they got to the point where they were kind of the Russian troops were coming in, right? If you think about that kind of an event, if you knew that tensions were rising, would you have, say, changed suppliers or ask your supplier to move your work out of Ukraine? Those are the kinds of things that when we're talking about medium impact events are not quite clear. And again, even though in hindsight, one might look at that and say, I probably should have done something about that sooner, a lot of times it's actually not clear in the moment. So that's why the action plan is really important, that you need to have the actions defined in advance, because if you actually wait for the trigger event to occur before you decide what to do, a lot of times you wind up doing nothing because it's just not clear if you should. If you already knew in advance what kinds of events you were looking for as triggers, then you'd already have your plan and you would make a decision about that faster. So I want to talk about some of the example medium impact events that we saw in our research as we've been tracking location-specific events for the first quarter. So some examples include Argentina erupting in protests over the mysterious death of the prosecutor, and some of you may recall that news, right? That's a medium impact event because it's not clear. It's certainly not a low impact event, but it's not clear that that will have fallout that would make it a high impact event. So that makes it a medium. Brazil's annual inflation rate hits the highest level in almost 10 years. That's also a medium impact because you have to put that in conjunction with everything else you know about the Brazilian economy and what impact that might have in terms of your ability to do work there, or even things like the rates that you're paying if you have third-party services being delivered out of Brazil, if that might have some impact on your contractual obligations. So that's something that would have a medium impact. China blocking VPN services that helped users access things like Google and Facebook. Again, in and of itself, not really minor, right, in the sense of because it could be an indicator of a bigger thing. So another medium impact event. Multiple power shortages and power tariff hikes in Manila, right? So for those of you who might have locations in Manila in the Philippines, either that you're doing work directly or you've got suppliers there, this is actually also a fairly impactful event and set of events. And then swine flu deaths, those are actually happening in multiple different Indian cities, and definitely something that has become moved from a lower impact event. The more recent impacts have been higher in the medium level. So we were talking about creating a response to those risks and those trigger events and taking an action. Before you decide what action you're going to take for each of those risks, you also really need to think about your tolerance for certain risks. So I want to highlight some of these things for you to think about as you're putting together your risk plans and your risk tolerance. So for example, whether or not you sell into a location or you only drive operations there makes a difference, right? So obviously, your location-related risk would be a lot higher if you're selling to that location, whereas if you had, say, a third party that was operating out of that location, and very often that provider may have alternative locations so that you could swap there. So as a result, you might feel like you have a little bit higher tolerance for location risk in cases where you're not as invested, right? That would be the obvious way to think about that. If you have, say, a delivery center and it's captive, so you own it, or if the work's done by a third party, again, your investment in that area is much higher. The risk to your business is much higher in the captive center environment versus the third party. So your tolerance for location risks and the action plan that you might have might be different depending on one of those factors. The ease of switching to another location. So even if it was your facility, so if you thought about, for example, the epidemics around some of the swine flu. If you had the ability to do the same work from a different location so that you had a higher tolerance for that risk because you wouldn't lose your operations, you just might lose, say, a day or so swapping from one facility to another, that's the kind of thing that you need to take into account when you're thinking about your risk actions and what you might do. And then your familiarity with a particular location. A lot of risk experts will tell you is that most people and companies actually, aren't most afraid of the things that will hurt them the most. They're most afraid of the things that are unfamiliar to them. So a lot of people take pretty high risks with things that they're just more familiar with, right? So the common example of that is most people are afraid to fly but not afraid to drive, even though in fact driving is riskier than flying. That actually applies to the broader kind of risk model here too, that very often as companies and as individuals, we're willing to overlook risks of locations that we've traveled to a lot or that are closer to us, and a lot of that familiarity makes us think differently about some risks that, if it were in a location that we haven't been to before or was really far away from us, we would actually view as being much riskier. So it's just important to recognize that about the risks when you're going through that, so that you can make sure that you're allowing for that, right? Because again, some companies just by nature are highly risk tolerant, and some companies have very low tolerance for risk, and sometimes it depends on these factors as you're putting it all together. So you have to think about your tolerance, not just the risk that you're assigning, because some countries and cities could have moderately high risk, but if you have a tolerance for that, that's actually not a problem, right? The problem comes in when the risk level of a particular location doesn't match your tolerance for that risk, or that it's higher than your tolerance for that risk. So if you think about, you've assigned a risk tolerance for your own organization and for a particular piece of activity or work that you're doing in a location, and you've assigned a risk level for a location that you're looking at, or for a risk category, right? So again, some of the macroeconomic risks, some of the financial risks, the infrastructure risks, etc. So you now have your categories of risks that you're looking for. You've got the trigger events that you're looking for. You know how well you can tolerate the certain risks, and now you're building your action plans to say, okay, if financial risk rises for a location, here are some actions that I'm going to take on that. Or if infrastructure risk starts to rise, I'm going to take these actions. So that's really where you're starting to get into the actionable part of this, and really making this something that your company can use, as opposed to just something that sort of in theory is interesting. And yes, of course, we should all be worried about risk, and yes, we should all be monitoring these things. But if you're just monitoring and not doing anything with it, it's not even worth monitoring, right? I mean, the only reason you're going to monitor something is because hopefully you're going to do something about it. So that's the part where it makes it actionable for you. So I wanted to actually use a couple of examples that I had just showed you earlier in the medium impact category, and talk about ways that you might think about implementing that kind of an action plan. So this is not a specific client, it's actually an aggregation of several different examples that we know, to not make it obvious who it might be. But for example, if you thought about a business, like let's say that this company is based in the UK and it does business in Asia, but that primarily the area of the Philippines is really a delivery location. So they don't really sell so much into the Philippines, it's just that they have some offshore work being done out of the Philippines. So if the event is multiple power shortages and power tariff hikes in Manila, now that's something that they have to start thinking about. And now in this case, the company has certain risk tolerance factors, right? They want to take a moderate approach because this is primarily a third-party location, so it's not a direct captive center. But at the same time, that third party is really critical to the company's operation. So this supplier is one of their strategic suppliers, and it really matters that the supplier succeed and do well here. So given that they've accounted for what kind of risk tolerance they can have in this location, they decided to take certain action steps. So if you think about power shortages on the one hand and power tariff hikes on the other, right, because those things are going together here, they decided to take a few specific interim action steps. They're going to research alternative power generation options. Maybe there's something else that they can do that hadn't been thought of yet, that maybe as a private enterprise that they could do, that they're not so reliant on the public infrastructure. They're going to evaluate their internal ability to switch work to other third parties that they already work with. So they're going to start to look at the set of suppliers that they already work with in Asia and say, maybe maybe they've got some suppliers in other regions, like say maybe in Vietnam, maybe even over to India or some other countries that they're going to look at and say, if this continues or if this gets worse, could we switch to somebody that we already work with? And the reason that for this company it matters whether or not they already work with the supplier is obviously it's a lot easier to give work to a company that you've already got an MSA with and that you've got a relationship with, rather than having to kick off an entire RFP, which actually will take quite a bit of time. So this company is actually already looking at its ability to switch. They're not switching right now. It's just they're looking at those options so that they're prepared if the event gets worse. And then they're actually involving their supplier. They want to co-create a risk mitigation plan with their supplier. So they want to understand what's the supplier doing to mitigate its own risk. I mean, that supplier works and is based in that country, right? So what kinds of things do they do? Do they have any other ideas of things that they could do? So for example, maybe the supplier's risk mitigation might be that they have a partner in another geography that they can transfer work to if that was required, or that they have some discussions going on with the local government to see what they can do to help be part of the solution to make sure that these things don't happen or don't continue to get worse. So they've taken certain action steps, and the final outcome is that they've decided to move to an alternative location if the power shortage happens twice more again in the next 6 months, or if the tariff increases make it so prohibitive to lose the cost advantage for that location compared to other locations where work could be done. So you'll notice that there were certain action steps that they have already started, and then there were outcomes that would require another set of actions if that were to get to that point, right? So an action plan isn't just do one thing, right? An action plan is actually, almost like a step function. If this happens, then we're going to do that, and if that happens, we're going to do this other thing. So hopefully to give you a sense of like how you can actually take some of these location-based events and make it more practical and really take advantage of what that would mean. So for example, in this case, if you thought about the moving alternative locations, I had worked with several clients who did have issues in Ukraine, and when Russian troops start crossing the border and you're thinking, okay, Ukraine also happens to have, there were a lot of concerns about state-sponsored hacking, things like jamming cell phones, for example, were other things that were going on there. And a lot of clients were saying, well, what can I do now? Should I cancel my contract with my, in this case, like application development supplier? Should I move locations? And if you didn't know in advance what you thought you would do in that situation, you're left a little bit to some other issues. So for example, if other clients of that same supplier already asked to be moved, so now they can't move you because now they're out of capacity in their other alternative locations. Or you're at their mercy based on what size client you are for them, because the bigger clients are going to have more pull, right? So if you wait until that event happens to try and take some actions, sometimes you don't have all the leverage that you could if you started to plan in advance. So that's why the proactive nature of this is really important, because you'd have more options open to you and you'd get better outcomes if you thought about what you could do before that happened. So you could kind of build those things into contracts. So you could build into a contract in the event of certain types of risks increasing or certain types of events happening, we want the ability to move locations, or we want to be able to exit for cause if certain things were to happen there. Those are the kinds of things that if you have an action plan, you can build into your contract so that you're covered when that event actually happens, as opposed to waiting and again, hoping for the best after the event happens. Another example is the recent news about the H1B visa. So the U.S. government has decided to extend eligibility for employment for dependents of H1B non-immigrants. So if someone is here on an H1B visa and they have a spouse or a child, of working age who comes with them but doesn't themselves have an H1B visa, they'd be eligible for an H4 visa, which basically means because they're in the country with the person with the H1B visa, they would be eligible to work here in the United States. So in our sample business, this is obviously a US-based company that uses a lot of Indian resources. It doesn't sell a lot in India. It does primarily its work in the US and in Europe. And again, this was the US extending eligibility for employment to the H4 visa. So there were certain risk tolerances that they had here, high switching costs of resources from India to other locations, but they had a high ability to switch among vendors within a scope of work or a category, but not necessarily locations, since this is Indian resources in the US, and the familiarity is pretty high, so most people are pretty comfortable. Now, you'll remember that I told you that this would be a medium impact event. Not all impacts are negative. I think sometimes when we talk about, oh, that has an impact on risk, we think of it as being negative. A lot of companies view this as a very positive impact on risk. So in fact, it would lower the risk of say people risk in suppliers that we're working with, and it would lower the scalability risks, for example, in India, because we'd have access to more talent this way. So it has a medium impact, but actually on the positive side. So I wanted to show you a positive event too, just because I think it's important to understand that while we tend to think of risk mitigation and risk management as insurance policy, like how do we make sure something bad doesn't happen, it actually can be used the other way around, which is to be proactive in making sure that good things happen. So because this company is tracking this issue and they're getting the alerts that say that these things are happening, so they're already discussing with current suppliers how many of their H1B visa resources might benefit from this change. How many people do they think would be affected, within their current sphere of suppliers for this, right? Maybe they're proactively going to look to recruit some of these spouses and dependents, right? Starting now, start talking to them now. The change doesn't become effective for another 2 months, but because they knew about it and because they were tracking this, they're able to get started now, just putting out feelers and maybe start talking to people. And the final outcome obviously isn't determined yet because the change hasn't gone into effect yet. But think about the positive impact that that could have. Like if you were struggling to find resources, then you might think, hey, this is another alternative source of supply that maybe we didn't have available to us before, and because we're proactively tracking it, we'll have better access to that maybe than some of our competitors who hadn't thought about it yet. Or it could even be something like it's going to increase the stability of the resources that are already here on the H1B visa, because it's going to be easier for them and their whole families to be in the US. And so as a result, that's something that might lower actually your supplier risk, even though this isn't a supplier specific event. This is actually more, again, at the macroeconomic level that we would track. Those are the kinds of things that you could be very proactive about. And again, sometimes avoiding bad, but also sometimes taking advantage of something good that's happening. And if you keep track of it and you know what you would do about it, right? Because again, if you just looked at an event like this and said, oh, hey, that's kind of interesting, and then do nothing about it, then you're not taking advantage of something that you could, right? So it's all about finding little pieces of advantage everywhere you can, because the more you can find all those pieces that other competitors aren't finding, then that's just going to put you further ahead. So I've been talking about some benefits, and I wanted to really just put them out there because, again, I think for the most part, people think of risk management as being avoiding bad, right? And of course it is, right? But at the same time, there's a lot more benefit on the proactive side of it. You'd get smoother operations because if you're proactive, you'd be able to avoid disruptions. So you'd have fewer disruptions to your delivery or to your supply base. You'd have a competitive advantage because proactive risk management likely means that you're better able to achieve an outcome than your competitors, or achieve a better outcome than your competitors as well, working even with the same supplier. Again, because the earlier in the cycle you recognize that a risk is potentially likely to happen, and you start to work with options, you just have more options than somebody who gets hit with the news right as it's happening, right? So the more proactive you can be, the more likely you're going to have a competitive advantage over your competitors in that area. You're going to have more options, right? So a faster, more proactive response means that if you had not waited, right, if you had taken advantage when you first saw it, you could just do more things, right? So again, think about the power supply issue in Manila. You, starting in advance, can think about switching suppliers. You can think about switching locations. You can think about taking something back in house. You could think about, building alternative power supply. If you wait until the power gets disrupted again, there's really nothing you can do other than wait for the power to come back on. And then yes, maybe you'd kick off another RFP afterwards to say, if you decided you couldn't put up with it anymore. But now you've wasted months and you have very few options left to you. So the sooner that you start to address something, the more options that you have, and very often the fewer options you have, the likelihood that those options are not good for you rises as well. So you want to be able to take advantage of the options that work in your favor. And finally, your ability to innovate. So as I was showing with the visa issue, not all risk events are negative. Some are positive. So think about a country building more infrastructure in key locations, right? So that their risk of infrastructure collapsing or not being sufficient for your needs actually lowers, which means you could invest more in a particular location. Looking for risk-lowering events helps you create opportunities for your firm in a way that not looking at location risk you just wouldn't be able to do here. So there's a real advantage to thinking about risk management as basically trying to find opportunities, right? So it's not always just, yes, of course I want to make sure that my facilities are running and they're not hindered by certain bad things that are happening, but the reality of the situation is also that you can take advantage of the positive, right? So that you're always looking for the competitive advantage. And a lot of times too, that's like what happens is as you start to look at this and you say, wow, there's something I could do there. There's some benefit that we would have if we thought about these risks a little bit differently or we were more proactive about it. So really benefit to some proactive location risk management. So I know that I have talked pretty much nonstop, but I wanted to make sure that we had plenty of time for questions, and we do. It is just about 20 minutes to the top of the hour, so I can take any questions that the audience might have. The chat is open online, so if you wanted to put a chat question in there or ask a question, I'd be happy to take any that you might have. So while we're waiting for the questions to show up, Laurence, had anybody emailed you a question?
Yeah, as we're waiting for folks to pipe up, maybe we could answer some of the common questions that we typically get around, what kind of parameters should you be on the lookout for, location-based. So maybe reviewing the NeoGroup risk model a little more deeply to give kind of ideas and a good framework for those looking to maybe implement something similar within their own firm.
Sure. So let's actually go back to that graphic just to kind of talk a little bit more about. So if you thought about some of these risks, so macroeconomic risks, each of these 8 categories actually, in our case, has multiple subcategories and subparameters underneath it, right? So macroeconomic includes tax issues, it includes issues of factors like GDP and inflation rate, and a lot of the things that obviously you'd sort of, we hear in the US on the evening news all the time about our own country, but that you would track it for another country. Similarly, geopolitical risks that can actually be political, right? So uprisings, changes in government. It could also be geographical in the sense of the weather, right? So it could be if it's monsoon season, if there are natural disasters, particularly for countries that have very well-known seasonal issues with the weather. Those tend to fall under geopolitical. So as you start to think about the different parameters that make up that category of risk, it becomes easier to get a bigger picture, right? Because again, a lot of times, if you separate yourself from kind of the emotional impact of something happening, right? Like something really traumatic, just think about a couple of years ago how there were so many typhoons happening in Asia and there were earthquakes happening in Asia, and just devastation for months afterwards, right? You can't stop those things from happening, and while you may not be able to predict a specific event, it is actually fairly easy to track over time whether or not those events are getting worse or getting more common, and also whether or not a region is, of course, prone to them. So if you start to think about those things in a broader picture, then you're able to put that together and to say, okay, if this happens, and when I say if this happens, that could mean you are tracking whether or not those natural disasters are happening more frequently, if they're happening with more severity, and then that's how you start to build your parameters of whether or not something is a high, medium, or low impact event that you need to take a look at, right? Because there's the event itself, and then there's the trend line of that type of event, right, which you have to put together. So again, this is the model that Neo uses in our Supply Wisdom product, and I do know that some companies have others, perhaps not quite so detailed models based on their own ability to capture some of this information, but that's how some of the people that we talk to, or how we help our clients think through what kinds of information they should be looking for. And if they put it together in the broader framework, it's actually easier to see what they should do about it, right? Because in isolation, it's very hard to figure out whether or not you should do anything about, a brownout in Manila that lasts for 12 hours, right? As part of a broader trend line, you actually have a much better sense of what you need to do. So that's why you can't just say watch the news and see something happen and then decide what to do about it. Not a very effective way to think about it. So you have to manage the individual events in the context of the trend line to help you decide what your action plan should be. Okay, I'm just looking through some of the other questions. And one that I see, Laurence, on my end is, how different are the risks for cities versus countries? And I would say actually they're not very different in terms of the categories and the parameters. They would be different in terms of scales, right? So if you thought about things like a change in tax code, you may not want to, say, take all of your work out of a particular country because the country's taxes on businesses are going up. However, at the city level, you might say it wouldn't be that hard to switch offices from one city to a different city. We actually do have clients, particularly doing work in India, that they've done that they knew that a tax holiday was expiring in one city, and they were able to move to another city that still had a tax holiday so that they didn't lose that advantage. So the risk categories tend to be the same, but the impact of those events might be different based on whether or not you're tracking a country or a city, and the actions that you might take could also vary based on whether it was a country or a city, because if you're talking about city-based risks, you do tend to have a little bit more flexibility than you do at the country level.
Great. Christine, we have an attendee who maybe I can broaden this a little bit. And the question is how easily does your information integrate with risk management tools such as RSA's Archer? And if we broaden that, maybe we could talk about how some of our clients use Supply Wisdom at the info level, or I'll turn it over to you and see how you would answer that.
Okay, sure. Yeah, and it's a great question, because while Supply Wisdom tracks the risks of suppliers and locations, definitely there are software tools like RSA Archer, other governance, risk, and compliance tools, and other kinds of even procurement tools that clients are using to track supplier risks, for example, and they want the data to pull out of it. So while Supply Wisdom can give you the scoring and the analysis around it, we do have a level called info, which is just basically exactly what it sounds like, which is the baseline data that we use to make all of the calculations. So if you didn't want to use the algorithm per se to track the specific risks, but that you wanted to just take the specific events themselves, and basically at the parameter level, you actually could take that data into another piece of software. I mean, it's not quite that simple, because I know that anytime anybody tries to port data from one piece of software to another, it's never as easy as it sounds with APIs, etc. Although in our case, it's a data download file that you then just upload to the other software, but that's what you would do. So it's possible to use it with other software, whether you're just sort of manually using it in terms of you want to take the data and have it be a factor in just your overall process that you're already using, or if you want the data to put into other software. That is something that we do at the info level. So there are some clients who just buy, in our case, the alerts, right? So they want to see the different events as they're happening, but they've got their own software, so they don't want to have two different models of risk, but they do like having the different alerts and the analysis that comes with the alerts. Then there's the info, which again is kind of the baseline data. And then there's the manager level, which is the full analysis of a location's entire risk profile and what you might do based on that.
I think that's a great overview of the three levels, of the three subscription levels that Supply Wisdom offers. And then, to get back to the attendees' question, for any city, country, or supplier that you subscribe to in Supply Wisdom, there's over 350 parameters that Supply Wisdom tracks. And so that's potentially a whole bunch of data that's specifically related to outsourcing that you would have access to on an ongoing basis for all of the, cities, countries, or suppliers that you're subscribing to. So mountain of data at your fingertips.
Right. And it is good to use, this software or some other software, because one of the things that we hear from our clients a lot is that they just don't have the resources to track all these things on their own, right? They don't have, people who are just sitting around reading newspapers and surfing the web and finding these things. So a lot of clients, again, whether they're using our model, our data, or they're using somebody else's, the use of software to automate some of that data capture, even if their governance process is actually pretty manual and they don't really have a full-time kind of risk management program, that data capture is actually a pretty important part, because I know that that's actually the biggest issue for a lot of people, is that they just don't have resources in their organizations to be able to track it themselves, so they like to have access to that.
Great. So here's a quick follow-up question. Does NEO track changes to special economic zones, such as in India or the Philippines?
So in the context of a city or a country, we would track it. So we wouldn't track a zone specifically because it had special status. We would track it if that was a location that, say, for example, a lot of NEO clients over the years have used, and so we track it. So, for example, if I think about India, we track the country of India at a location level, but we also track Pune, Chennai, Hyderabad, Bangalore, New Delhi, Mumbai as separate individual entities. So you could track each of those cities, again, either because you were already having work being done there, or you were thinking about having work being done there, and you could track the different special status events that might be happening, like, say, for example, a tax holiday in a particular city. You could do that. And the same with the other countries, that, again, so depending on how big the country is, sometimes we have data for multiple cities, and sometimes we have, in some cases, like Costa Rica, for example, we track just Costa Rica as one entity. But in other cases, like the Philippines, we would track Manila separately from the country of the Philippines. So that would actually be two different ways to look at it. You could look at it at the city level and at the country level.
That's great. So I think, in short, changes in status to a special economic zone, yes, that is a parameter that would be captured, as Christine said, within the context of a city, a specific city or a specific country. So maybe we'll give another couple of moments and see if anyone else has any questions. And as we wait another few moment. Christine, I'll give you a chance to give any final thoughts or closing pieces of insights.
Okay. Yeah, and I wanted to thank everybody again for joining, and hopefully what you've gotten out of this is that there are actually some very specific things that you can do based on events that are happening at a city level or a country level. So again, I know that from having talked to a lot of you and talking to just people in general about supplier-related risk and location risk, that location risk seems to be a lot more difficult to get a hold of than supplier risk. Supplier risk, a lot of times I think companies feel like, okay, I get it, right? I work with a supplier. I see them facing these risks. I can take these actions. But I hope that what you're pulling out of this particular webinar is that you have as much ability to take action at the broader level around cities and countries. So being able to address location risks as you do as supplier risk. Because really, if you only are dealing with supplier risk, you're not really optimizing because suppliers are, obviously a factor of the location that they're operating in and the multiple locations that they operate in quite often. So hopefully, again, I want you to just understand that there are ways that you can actually take action at the location level, and you don't just sort of have to take it and say, well, there was nothing I could do about, this particular event because, I can't change what a government's going to do. Like, well, no, of course you can't change what a government's going to do, but you can have a plan of action based on some of the likely occurrences that might happen in the country. So that's the biggest message of the entire webinar, is that the location-based risk is actually absolutely something that you can deal with, and it's not really throw your hands up in the air, there's nothing that can be done about it. You absolutely can do something about it, and you can actually take advantage of it. It's not just mitigating the bad. You actually can take some very good proactive and productive steps for your company by thinking about the location risk separately from the supplier risk.
Thank you, Christine. Lots of great insights, hopefully some good action steps that attendees can apply within their own organizations. As always, if any of you have any follow-up questions or maybe would prefer a one-on-one discussion, don't hesitate to reach out. We're always here to help and happy to help. Again, thank you everyone for joining, and see you all soon, hopefully on another webinar. And thank you, Christine.
Thanks, everyone.